Imagine you're looking at a company that just reported like $50 million in earnings.
That's pretty good.
Right. Wall Street is cheering, the financial press is totally celebrating, the stock is soaring. But what if I told you that same company doesn't actually have enough physical cash in the bank to make payroll on Friday?
Yeah, welcome to the ultimate corporate accounting illusion.
It's wild, navigating that confusing and honestly, sometimes deliberately conflicting mound of financial data that companies release. That is our mission for this deep dive.
Because it really is a phenomenal sleight of hand. You have all these observers and investors digging through mountains of indicators, and they just assume the numbers reflect a concrete reality.
Yeah, you assume math is math, right?
Exactly. And yet, the exact same quarterly earnings report can paint two completely different pictures of a company's performance. It is entirely dependent on which specific calculation the company wants you to focus on.
Which is crazy to think about because the reality is, if analyzing the financial strength of a company was as easy as reading a single number on a page, well, as our source material today puts it perfectly, we'd all be named Warren Buffett.
We would. But instead, we are left trying to decipher this diagnostic landscape that is incredibly murky.
Yeah.
I mean, it is not a clean binary scoreboard where Team A has 90 points and Team B has 80.
Yeah, it's so much more complicated, which is why we are pulling from some really fascinating excerpts today from an article titled EBITDA, Evaluating the Merits and Pitfalls of a Financial Metric.
Oh, EBITDA. It's such a polarizing topic in finance.
It really is. The central tension we are unpacking today, the real dilemma at the heart of modern corporate finance, is that depending on who you ask, EBITDA is either the single most excellent, insightful way to compare the financial strength of two companies, or it is nothing more than a cheap accounting trick designed to mask failure.
And, the underlying truth, as the source points out, typically falls somewhere right in the middle of those two extremes. I mean, it is a incredibly powerful tool, but a dangerous one in the wrong hands.
So why does this matter to you listening right now? Well, whether you are prepping for a major business meeting, or maybe you're dabbling in your own personal investing, or, you just want to understand the real story behind those flashy quarterly earnings reports driving the news cycle, this deep dive is going to give you the diagnostic tools you need.
Yeah, you really need to be able to spot when a company is actually thriving versus when it is just playing games with the math.
Exactly. So to spot the game, we first have to understand the foundational rules that this metric was essentially built to bypass, right?
Right. We need to go back to the standard baseline, the traditional rules of the game.
And we all know the GAAP gold standard, generally accepted accounting principles.
Yes. Good old GAAP.
Under GAAP, calculating a company's profit like its net income is rigorous. It is the bottom line after the dust settles. You take the gross revenue, every dollar that came in, and you subtract all the expenses.
Every single one.
Right. The raw materials, the payroll, the rent, the taxes, the interest on loans, the depreciation of your assets. It basically forces you to account for all the ugly stuff.
It does. It is a comprehensive picture of financial reality. Under GAAP, if you spent the money, or if an asset lost value, it hits your bottom line, period.
But then the 1980s happened.
The 1980s, yeah. The 1980s corporate landscape brought a very specific kind of disruption that demanded a completely new way of looking at the numbers. And this is the environment where EBITDA was popularized.
EBITDA, earnings before interest, taxes, depreciation, and amortization.
Correct. And this metric was championed by a completely new breed of companies that specialized in something called leveraged buyouts.
Right, and our source notes these leveraged buyouts were an especially risky type of hostile takeover.
Highly risky. And honestly, the audacity of the leveraged buyout is really the key to understanding why EBITDA gained such traction in the first place.
How so? Like, how did it actually work?
Well, in a leveraged buyout, a corporate raider identifies a target company they want to acquire. But instead of using their own cash to buy it, they borrow a massive amount of money.
Okay.
And the kicker is they use the assets of the target company as the collateral for that massive loan.
Wow.
Yeah, they essentially force the company they're buying to shoulder the debt used to conquer it.
That is a staggering amount of debt just suddenly appearing on a company's balance sheet overnight.
Staggering is exactly the right word. And because these buyouts carried such phenomenal debt loads, the traditional net income of those newly acquired companies just plummeted.
I mean, of course it would.
Right, the interest payments alone were burying them under GAAP standards. Their bottom line looked absolutely terrible to the outside world.
So the optics were bad.
Terrible optics. So the architects of these buyouts needed a new narrative. They popularized EBITDA as a supposedly more accurate measure of the company's long-term profitability.
Ah, I see.
Yeah, by carving out the interest payments, the taxes, and the depreciation, they argued they were stripping away the financing costs to reveal the pure day-to-day operational strength of the business.
Okay, let's unpack this
Yeah,
because I want to make sure I am fully wrapping my head around the mechanism here.
sure.
Is calculating EBITDA essentially like bragging about how much money you make from your weekend side hustle, but conveniently leaving out the fact that you owe like 30% interest on the massive credit card debt you took out to buy the equipment for that side hustle?
That is a very apt comparison, yeah.
And you also aren't setting aside a single dime for the taxes you're going to owe the IRS at the end of the year.
Exactly. That analogy captures the sleight of hand perfectly. You are basically pointing a massive spotlight at the cash coming in from selling your service, shouting, "Look how profitable my core operation is," all while actively ignoring the structural debt and tax obligations that actually allow the operation to exist in the first place.
I mean, that just feels inherently deceptive. You are asking investors to ignore the very things that could bankrupt the company.
Well, what's fascinating here is the underlying logic of the argument, at least in its original form. The proponents of EBITDA weren't necessarily framing it as a deception.
They won't.
No, their argument was that financing decisions, like how much debt a company takes on, and tax jurisdictions are totally separate from the fundamental quality of the product or service itself.
Oh, I see.
Yeah, they believe that what remains after you strip away those specific costs is a pure measure of a company's raw ability to make money on the factory floor or the retail shelf.
Okay, so if I'm comparing a legacy retailer that owns all its real estate free and clear to a brand new competitor that is leasing everything and drowning in expansion debt, traditional GAAP net income is going to make the legacy retailer look like a genius simply because of how they are financed.
You've hit on the exact defense of the metric. The legitimate value of EBITDA lies in making true apples-to-apples comparisons.
Okay.
When you use it to compare two traditional businesses within the same industry like manufacturing or retail, it can be incredibly illuminating. It reduces the financial noise.
So it levels the playing field so you can see who is actually better at selling shoes or building cars completely, regardless of their debt structure.
Yes, it isolates the engine of the business.
Yeah.
Think about it like this. If Factory A was bought with cash 20 years ago and Factory B was heavily financed last year, their net incomes will be wildly different.
Because of the loan payments.
Exactly. But if you want to evaluate the efficiency of their actual manufacturing processes, EBITDA strips away that loan interest. It reduces the financial picture down to a single number representing the ongoing income generated solely from those core operations.
Right. Okay, but here's where it gets really interesting and where I have to push back a little based on what our source material reveals.
Okay, yeah, go for it.
If EBITDA is such a brilliant tool for comparing two similar factories and evaluating the raw power of their core engines, why does the text specifically warn that non-traditional high-risk businesses use this metric to take a bad investment and paint it gold?
That's a great question. And it's because an engine doesn't run in a vacuum. It requires a broader vehicle to sustain it.
Right.
EBITDA works beautifully when evaluating traditional, stable companies with predictable, easily understood capital expenses. But the illusion begins the moment a volatile, high-risk company starts wielding EBITDA not as a supplementary tool, but as a substitute for actual cash flow.
Oh, wow.
Yeah, they use the metric to focus investors entirely on the operational revenue, completely obscuring fatal structural flaws in their business model.
But wait, if we are evaluating the engine of the business, doesn't that engine run on actual cash? Like, if EBITDA ignores how the car is financed, does it also ignore if there's actual gas in the tank?
Yes, and that physical disconnect is the first major pitfall of the metric. This brings us to the danger of mistaking paper earnings for actual cash flow.
Which are not the same thing.
Not at all. Cash flow doesn't just indicate how much a company earned and spent. Crucially, it dictates the timeline of survival. It indicates when the cash actually changed hands.
Right.
And the text makes it abundantly clear. Earnings, as calculated by EBITDA, and physical cash in the bank are not the same thing.
And the source breaks down the crucial mechanism behind this, right? The difference between accrual accounting and cash accounting.
Yes, this is a vital distinction.
Because accrual accounting, which EBITDA relies on, counts a sale the exact moment a product ships out the door to a retailer.
Exactly.
But cash accounting, which is reality basically, only counts that sale when the retailer actually pays the invoice in full.
Right. And the warehouse anecdote from the text perfectly illustrates why this distinction is literally life or death for a company.
Oh, yeah. Break that down for us.
So imagine a manufacturer spends real physical cash to secure raw materials and pay workers to build a product. They box it up, they ship it to a retailer, and instantly, under accrual accounting, they recognize that revenue.
So their EBITDA spikes.
Exactly. Their quarterly earnings report looks spectacular. But what if that product sits on a pallet in the retailer's warehouse for 12 months before the end consumer buys it, and the retailer finally pays the manufacturer?
So for a whole year, the manufacturer has millions in paper earnings, but zero actual new cash hitting their bank account.
Precisely. And without actual cash replenishing their treasury, that company cannot pay its own downstream creditors.
They're stuck.
Totally stuck. They can't secure raw materials for the next production run. They can't pay the rent on their own facility. They might not even be able to make payroll next week.
Wow.
Being highly profitable on paper does not prevent a company from bleeding to death from a lack of liquidity. That disconnect leads directly to emergency borrowing or straight-up bankruptcy.
Think of it like this. Imagine it's December, and your boss sits you down to promise you a massive year-end bonus.
Okay, a nice scenario.
Yeah. But if you treat that promise like it's already cleared your bank account, which is essentially the accrual accounting mindset, you might go out and buy a new car, book a luxury vacation, max out your credit cards based on that promised influx of cash.
Right, because you feel rich on paper.
Exactly. But if the company delays cutting that bonus check for 6 months due to some administrative error, you are going to default on your mortgage in the meantime. The promise of future money does not satisfy the immediate demands of your creditors.
That's a great way to put it. And if we connect this to the bigger picture, that is the foundational danger of relying solely on EBITDA. It presents a veneer of liquidity.
A veneer.
Yeah, because the metric focuses exclusively on money earned from daily operations.
Mm.
It visually resembles cash flow to an untrained observer. But they operate in different physical realities. EBITDA simply does not accurately represent the cash a company has collected.
And the reality check gets much harsher, doesn't it? Because it's bad enough that EBITDA counts money that hasn't arrived yet. But the source highlights that it also deliberately ignores massive inevitable bills that absolutely must be paid.
Oh, yeah.
The government and the banks do not care about your core operational efficiency. They want their cut.
They absolutely do. And the first two ignored items are spelled out in the acronym itself, interest and taxes.
Right, the I and the T.
EBITDA pretends these obligations do not exist in order to show that pure operational income. But in the physical world, a company's cash treasury is heavily depleted by these two forces.
A business absolutely must pay interest on its debt, and it absolutely must pay its taxes long before it can even consider paying dividends to the investors who are looking at that EBITDA number.
Exactly. The cash to pay the bank and the government has to come from the very operational revenue that EBITDA is boasting about.
Right.
By erasing interest and taxes from the equation, the metric projects this fantasy scenario where the company just gets to keep everything it earns.
Which brings us to the D and the A, depreciation and amortization. Our source material emphasizes that these are accounting methods used to spread out the expense of large capital investments over time.
Yes. And this is where the mechanism of EBITDA becomes particularly perilous. Let's look at depreciation.
Okay.
Imagine buying a massive fleet of delivery vehicles, or maybe outfitting a huge server farm. A company does not take that entire multi-million-dollar expense as a massive hit to its net income in a single year, because those assets are going to generate value for the next decade.
Makes sense.
Instead, the company depreciates the asset. It spreads the cost out over its useful life.
But depreciation isn't just some abstract paper loss, right? It represents the physical degradation of the assets. Like the gears and the machinery are literally wearing down. The servers are becoming obsolete.
Precisely. It is an acknowledgement that your assets are aging and will eventually require massive amounts of cash to repair or replace.
Yeah.
And the source specifically notes that ignoring depreciation is incredibly dangerous when evaluating young, capital-intensive companies.
So, what does this all mean? If a young tech startup requires millions of dollars in servers just to function, or a new manufacturer requires specialized machinery to build their product, EBITDA just shrugs and ignores the long-term financial reality of having to maintain and eventually replace all of that equipment.
That's exactly what it does.
How is that even legal under standard accounting practices?
Well, the blunt answer is that under GAAP, it isn't.
Oh.
Yeah, EBITDA is a non-GAAP metric. It is an alternative calculation. And that distinction highlights the inherent vulnerability for the investor.
Because it's not the official standard.
Exactly. When you step outside of generally accepted accounting principles to rely heavily on an alternative metric, you are entering a space where the company is allowed to define its own
Which
success.
is terrifying.
It is. They do this by deliberately ignoring the exact expenses, structural debt, taxation, and capital aging that historically drive young companies into the ground.
And because it ignores these massive financial realities, the metric practically evolved into the perfect camouflage for companies whose business models were fundamentally broken.
Oh, absolutely. The lack of strict regulation compared to GAAP net income made the numbers incredibly easy to manipulate.
Right.
Dangerously leveraged companies, businesses drowning under the weight of their own debt, they latched onto EBITDA to skirt standard accounting transparency entirely.
And the text gives us a glaring historical example of this blowing up in spectacular fashion, right? The infamous dot-com flameouts.
Yes, the late 1990s and early 2000s are just a masterclass in the abuse of EBITDA.
Set the scene for us there.
So during the dot-com boom, you had these tech companies reaching astronomical market valuations while bleeding actual cash at an unprecedented rate.
Just burning through money.
Burning through it. They were spending fortunes, building massive server infrastructures. They were funding aggressive Super Bowl-level marketing campaigns.
Oh, yeah, I remember those ads.
Right. And they were financing all of this aggressive growth by taking on massive amounts of debt.
So if you looked at their traditional net income under GAAP-like, incorporating all the interest on that debt and the physical depreciation of those expensive servers, they were deep in the red.
Deep in the red.
The standard accounting would show a failing enterprise.
Exactly. But they didn't point investors to GAAP. They pointed the spotlight aggressively at their EBITDA.
Just shining a light on the one good number.
Yes. They used the metric to hyper-focus investors on their gross operational margins.
Yeah.
The sheer volume of clicks or immediate ad revenue.
Wow.
And this narrative effectively hid the fact that their structural foundation was collapsing. They were using EBITDA to construct an illusion, basically painting a terrible, debt-ridden investment as a golden opportunity.
And when the dot-com bubble finally burst and the creditors actually demanded their money, the actual physical cash simply wasn't there.
It was gone.
The paper earnings couldn't save them from the physical reality of bankruptcy.
No, it couldn't. And that widespread history of manipulation is ultimately what earned the metric such a suspect reputation among Wall Street analysts.
Which really makes sense. And this raises an important question for anyone looking at financial data today. How much faith should we put in alternative metrics when the historical record shows us they are so frequently weaponized to obscure the truth?
Well, it demands an elevated level of critical thinking. Whenever a company's leadership...
Yeah, look closely at which metric they are actually using to make that claim. Are they showing you their real GAAP-approved net income, like the actual physical money left over after the government, the banks, and the wear and tear of reality have taken their cut?
The real bottom line.
Right. Or are they showing you an EBITDA number that conveniently strips away the uncomfortable realities of their debt and their aging infrastructure? Are they showing you a truly thriving business, or are they just painting a bad investment gold?
It fundamentally requires moving beyond the headline number and understanding the physical mechanics operating underneath it all.
It really does. And, reading through these sources and looking at how these massive entities manipulate their scoreboards, it leaves me with this final, somewhat provocative thought.
Oh, I like these. What is it?
Well, if multi-billion-dollar companies can champion alternative metrics like EBITDA to conveniently ignore their biggest, most stressful expenses just to make failing business models look wildly successful on paper, it makes you wonder about the metrics we apply to our own lives.
Oh, wow.
Yeah, what kind of personal EBITDAs do we use every day?
That is a very compelling parallel. I mean, we frequently strip away the hidden costs of our own decisions to present a better bottom line.
Exactly. Do we measure our personal success by vanity metrics, like the sheer number of followers we have on social media, or our gross salary on paper, while completely ignoring the real-world interest and taxes that those achievements demand?
The hidden costs.
Right. The relentless drain on our free time, our chronic stress levels, our mental health. Are we putting a spotlight on our gross revenue while actively ignoring the underlying costs that are quietly bankrupting us?
A necessary reality check. It applies just as heavily to corporate balance sheets as it does to our own well-being.
It really does. So the next time you look at a scoreboard, whether you're evaluating a tech startup or your own career trajectory, I hope you remember to check if you're looking at a clean, transparent X-ray or just a really clever illusion. Thank you for joining us for this deep dive. We will catch you next time.